We're back. We're now ready to prepare what's known as a flexible budget for Larry's lawn service. Recall in the first video, we prepared a planning budget. It was static. It was based upon a set amount of lawns being cut. But we now prepare a flexible budget to compare the actual numbers that took place for the period. So now with a flexible budget, we're going to use our same formula here, except now we're going to plug in Q as the actual number of lawns that was cut. So we're going to take in the form that we prepared in our first video, but now we're going to plug in Q. Q stands for the actual number of lawns that was cut in the month of June. So since we cut 550 lawns, this is the total revenue that we should have earned based upon cutting 550 lawns. These are all the expenses we should have incurred based upon cutting 550 lawns. And this is the net operating income we should have earned based upon cutting 550 lawns. Come back to that. So now we're going to look at what we call an activity variance. This is a variance solely due to the difference in the actual level of activity and the level of activity in the planning budget. So we'll take a look at our flexible budget to determine the actual variances that Larry's lawn service incurred during the month of June. Okay, so we're now taking a look at the flexible budget first, compared with the planning budget. So once again, the flexible budget shows the numbers we should have based upon producing 550 units, where the planning budget shows the numbers based upon producing 500 units. Okay? So notice that we have a favorable revenue variance of 3,750 when we cut 550 yards compared to the planning budget, which is predicated upon cutting 500 yards. Okay? Now with the wages and salaries, we see that for wages and salary, it's going to be unfavorable. And that's simply because we cut more yards than expected. So at $30 per yard, you could expect that to be a favorable variance because we cut 50 more yards than that was planned. So this variance actually makes sense. Okay? Same is true for the gasoline and equipment maintenance. Again, because we cut more yards, we could expect that those amounts are going to be higher. The other items we have for office and shop utilities, these are all fixed costs within a relevant range. So notice that they're going to be the same under the flexible budget and the planning budget. Because again, these fixed costs remain constant within a relevant range. So when we compare our flexible budget against our planning budget, we are overall favorable by $1,650. The revenue variance was favorable by $3,750. Expenses unfavorable by $2,100. So overall, our net operating income was favorable in the amount of $1,650. So that's comparing the planning budget, which is based upon producing 500 units, against the flexible budget. This is showing what the results should be based upon cutting 550 yards. This is showing the flexible budget. Okay? Now, let's interpret revenue and spending variances. So we'll take a look at revenue and spending variances We'll look at the actual revenue compared to the flexible budget revenue, not the planning. We're going to compare actual revenue against the flexible budget revenue. We'll compare actual costs based upon the flexible budget cost. So let me set this up for you. The flexible budget revenue says that if our formula is correct, we should earn this much revenue based upon this level of activity. We should have spent this much money based upon the actual level of activity. So we're going to compare what the budget said should have happened against the actual results. We'll look at the actual revenue earned for the period and the actual cost that took place and compare that against our flexible budget amounts. So you ready? Let's compare. Okay. So here we see the actual results for Larry's Lawn Service compared to the flexible budget. All right. Now, from a revenue standpoint, it's favorable. The actual revenue earned was more than we expected, most likely because the clients provided us with tips for cutting their different lawns. So that's a good thing. But what's not good is the cost. We expected to spend $21,500 based upon this formula. We end up spending $23,500. They gave us an unfavorable variance of $2,000 in forms of labor costs. So we want to take a look at that. Why did we spend more money than what we projected? Is $30 per lawn an actual figure? I mean, that figure reasonable? We need to figure out why is our wage and salary cost $2,000 higher than what was expected. Gasoline supplies, unfavorable by $150. So we spent a little bit more on gasoline and supplies than what we estimated. Not too bad. It was over by $150. Then we have some favorable variances. Our equipment maintenance cost was $350 less than what was expected, so that's favorable. Our office and shop utilities was $50 less than what was expected, so that's going to be favorable. Okay? And then the insurance was $200 higher than what projected. That's going to be unfavorable. So overall, our expenses for the month were unfavorable by $1,950. So since the expenses were higher than the favorable revenue variance, overall, we had an unfavorable net operating income for $200. Based upon cutting 550 lawns, we expected to make a profit of $6,650. Our actual profit was $6,450. So once again, it wasn't too bad of a variance, but you want to ask yourself what's causing that. Did we perhaps do some extra services for these clients that warranted the extra revenue? But at the same time, did we have to pay our employees a little bit more money because of those extra services? That is your job to get to the bottom of what caused these unfavorable variances shown on this analysis report. Okay? So next we'll look at how to prepare a performance report with one cost driver that combines activity variances and revenue and spending variances. We're going to put some things together. So now we're going to use the flexible budget concept to combine the revenues and the spending variances for Larry's Lawn Service. Okay? So now we're pretty much showing everything. Here we have the actual results that took place. Here we have the flexible budget, and here we have the planning budget. So we have everything combined into one performance report, actual results, flexible budget, and your planning budget. Okay? So this first variance is comparing actual results against the flexible budget. And to get that 1750 as being a favorable variance. Next, we're comparing the flexible budget against the planning budget to get the favorable variance of 3,750. So these amounts here are comparing actual results against the flexible budgets. These variances here are comparing the flexible budget against our planning budget. So now we combine all three together, actual results, flexible budget, and the planning budget to see the different variances between these different budget reports. Okay, so we can see again, overall, when you compare actual against flexible, we were unfavorable by $200. When you compare the flexible against the planning, we were favorable by $1,650. So we can look at this a few different ways. You could say, yes, based upon 550 yards being cut, we should have had a higher net operating income. However, we only expected to cut 500 yards and make a profit of 5,000, but we end up making a profit of more than that overall. So we're comparing again the actual results against the flexible budget compared to the planning budget. Okay? So again, these numbers that's shown here are just a reflection between, in this case, actual results against flexible budgets, and the other one shows a difference between flexible budget compared to the planning budget. Okay? What about a performance report for a nonprofit organization whose focus is not necessarily so much on revenue, but in providing different services? Now, if you're a nonprofit organization, you may receive funding from sources other than selling goods or services, right? So often funding for university, for example, or state funding, tuition and fees, donations often from alumni, as well as endowments that have been left on behalf of that university. Okay? If you have a cost center, what are going to be your performance report? So in a cost center, these reports typically are prepared to show the same purpose as so far, except we don't have any revenue. We're just comparing costs. We're comparing budgeted costs against actual costs. So often in a cost center, we do not have any revenue, but it's the same concept, except now we're going to compare actual costs against budgeted costs. Okay? Next, we'll come back and prepare a flexible budget with more than one cost driver. If you recall, our previous budget was simply based upon the number of lawns that we mowed within a month. That was just one cost driver. We're going to come back and prepare another flexible budget, but this time we're going to have more than one cost driver. Stay tuned.